Let's look at instruments in action. Now that you know who trades and why, it's time to look at how they do it, with powerful tools called derivatives. In this lesson, you'll explore how traders use CFDs, options, and futures to speculate, hedge, and manage risk. Let's start with derivatives. These are financial instruments whose value comes from something else, like a stock, currency, or commodity. Derivatives don't give ownership of the asset. They let you trade its price movements. Derivatives allow traders to control larger positions with less capital. Instead of paying the full price of an asset, you only need a fraction, known as a margin. This means even small price movements can lead to significant gains or losses, making them attractive for active traders. Many investors use derivatives to protect against potential losses, a strategy called hedging. For example, a company that relies on oil may use futures to lock in fuel prices, protecting itself from future price spikes. Similarly, stock investors might buy put options to limit downside risk. Derivatives also offer a way to profit from both rising and falling markets. Traders can take long positions if they expect prices to rise, or short positions if they anticipate a drop. This makes them a popular choice for short-term opportunities based on price movements. Lastly, with derivatives, you don't need to own the underlying asset. You can trade stocks, commodities, currencies, or indexes from a single platform without physical ownership. This gives you exposure to a wide range of markets and strategies. Time for a quick quiz. By looking at the statements, choose the correct option. Who is using derivatives for speculation? Is it an investor trying to profit from a potential price swing, an airline locking in fuel prices for the year, a business protecting itself against currency fluctuations, or a company securing future prices to avoid cost surprises? No, the correct answer was an investor trying to profit from a potential price swing. Not quite. The other examples describe hedging, using derivatives to manage risk. Only one choice reflects a trader aiming to profit from market movement. Now that you know why traders use derivatives, let's look at how. One common type is the contract for difference, CFD, a way to trade price movements without owning the asset. You can profit from both rising and falling prices by buying or selling the difference. The logic behind CFDs is simple. If you think the price will rise, you go long, buy. If you think it will fall, you go short, sell. You profit from the difference between these two. We will talk more about CFDs in an upcoming lesson. CFDs are flexible, leverage tools for trading short-term price moves in markets like stocks, forex, or commodities. They let you profit in both directions but come with higher risk if the market moves against you. As you remember, an option gives you the right but not the obligation to buy or sell an asset at a set price before a set date. Options can be used to speculate or hedge risk. A call option gives you the right to buy, while a put option gives you the right to sell. You pay a fee called a premium for this right. If the market moves in your favor, the option increases in value. If it doesn't, you can let it expire. Your maximum loss is limited to the premium you paid. Quiz question. Jane believes that a company's stock, which is currently $100, will rise in the next month. She doesn't want to risk buying the stock directly, so she considers using an option. Which option strategy should Jane choose? Should she buy a call option to profit if the stock goes up, do nothing and hope the price rises, buy a put option to protect against a price drop, or sell a call option to collect premium? No, the correct answer was buy a call option to profit if the stock goes up. Oops, buying a call option lets Jane profit if the stock goes up, while limiting her risk to the premium paid. It's a common strategy for bullish traders who want upside potential without committing to the full stock price. Options let you trade with defined risk. You pay a premium for the right to buy or sell an asset. They're useful for both speculation and hedging, with losses limited to the premium paid. A futures contract is an agreement to buy or sell an asset at a fixed price on a specific date in the future. Unlike options, futures are binding. You're obligated to complete the deal when the contract expires. Quiz question. A coffee company expects coffee prices to rise in the next 3 months. The current price is $200 per bag, and they plan to buy 1,000 bags. They decide to use futures to lock in the current price. If prices rise to $250 per bag in 3 months, what's the benefit of using a futures contract? Does the company pay $250,000 because it followed the market price, lose $50,000 because the market moved higher, have no financial impact because futures are optional, or save $50,000 by paying the locked-in $200 price? Yes, you're right. Exactly. By locking in the $200 price, the company avoids paying the new market price of $250. That's a savings of $50 per bag times 1,000 bags, or $50,000 in total. Futures are used for longer-term exposure or hedging large positions. They lock in prices but require more capital and carry an obligation at expiry, making them better suited for experienced or institutional traders. Knowledge check. Derivatives and their use. Drag each derivative type to its most common use or trait. Great job! You now understand how CFDs, options, and futures work, each offering different ways to trade based on time frames, flexibility, and risk. This knowledge helps you choose the right tool for your trading style. Now let's apply it through real-world examples. Step into the market. You're about to enter the trading world. In each scenario, you'll take on a specific role, from a retail trader to a corporate risk manager, and make decisions using real trading tools. Can you make the right call under pressure? Let's find out. Time for a quiz. Let's say you're a retail trader with $5,000. You spot a fast-moving tech stock that's starting to rise quickly. You expect a short-term price jump, but you don't want to risk too much. What is your best trading tool? Should you use a CFD for short-term speculation, use a futures contract, buy a put option, or buy the stock directly? Yes, you're right. Smart choice. CFDs allow flexible, leveraged trading with less capital upfront, perfect for short-term price action. Now imagine you're a finance manager at an airline. Fuel costs are a huge part of your budget. Oil prices are rising fast, and you're worried this might hurt profits this quarter. What's the best derivative tool to reduce your fuel price risk? Should you buy oil stocks, enter an oil futures contract, open a CFD, or buy a call option on Tesla? Yes, you're right. Exactly. A futures contract lets your company lock in fuel prices now and avoid future volatility. You expect that Apple's stock will jump after its earnings report in 2 weeks? You want to profit from the move but also limit your downside risk. What strategy fits your plan? Should you buy a futures contract, buy a call option, go short, or buy the stock? Yes, you're right. Great pick. A call option lets you benefit from upside potential with limited risk, just the premium you pay. You're trading crypto on weekends. A whale just moved millions into Ethereum, and you expect extreme volatility in the next few hours. Do you think CFDs are a good tool to capitalize on short-term crypto volatility? Yes, you're right. CFDs let you speculate on fast-moving markets like crypto without owning the asset, but leverage increases risk. You're managing finances for a company that imports machinery from Europe. The euro to US dollar exchange rate has been volatile, and your company will need to pay in euros next quarter. What's the best way to protect against unfavorable exchange rate changes? Should you use a CFD on euro to US dollar, buy a put option on Forex, use a Forex futures contract, or buy euros today and hold them? Yes, you're right. Exactly. Forex futures let you hedge against currency fluctuations and protect business costs. You just stepped into the shoes of real world traders and risk managers. From quick speculative moves to long term hedges, you've seen how different tools serve different goals. Next, we'll shift gears and dive into market behavior, understanding how price movements unfold and how traders read the story behind the charts.